For the second year in a row, the S&P has returned about 25% in terms of total returns. The question for us now is whether 2025 can yield similar results. We're going to talk a little bit about that and take a couple of questions on this holiday, January 1st. Happy New Year. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, this time from Bend, Oregon. Because of that, I don't have some of the features that I sometimes do when I'm actually at my own desk, but hopefully we can take a few questions and answer them for you. As I was just alluding to, now that the year's tallies are in, the total return for the S&P with dividends reinvested was just on the high side of 25%, depending on how you do your calculations. Of course, you could have taken any dividend payments and potentially put them into cash, which now actually does pay some rate of interest. In front of you, if you have my screen share up, I don't know if you do or not, but if you do, this is the S&P over the course of the last 2 years. And we can see that we've had two pretty extraordinary years in terms of returns. There have been instances in the past where we've seen very strong years followed by another strong year and then followed by another strong year. In fact, actually, the one that I've heard mentioned more often than not lately was 1998. So I'm going to actually go back in time here so we can take a look at the period from 1996 until 1998. This is what that looked like. You can see we had a big swoon in here. There was a sovereign debt crisis at that time. There was a crisis basically going on. In the late 90s, there was two big crises that went on. One was the sort of the collapse of the Asian tigers, and then, of course, the more notable one was the Russian default. The Russian default, among other things, was part of what took out long-term capital management, the hedge fund managed by John Merriweather and a couple Nobel laureates. But the equity markets managed to recover from that and actually finish the year higher. And I bring this up because I think there's a tendency to believe that it's impossible for markets to continue that kind of strength unchecked for a long time. And I just threw into that same chart now, I've added 1999, and we can see that 1999 was actually a good, strong, positive year as well. And in fact, the market continued higher up until March of 2000. And that ultimately is when the tech bubble collapsed. So I bring this up because I think there's a temptation to think that because we've had two very strong years that it can't be followed by another. That's not necessarily the case. However, there are things that I think we should be a little bit concerned about. For that, we're going to take first a look at valuation. Valuation is a terrible timing tool. It's going to be illustrated as such here. What I'm going to take a look at is the best PE ratio in this case. So that is the best guess. So the estimated earnings for the S&P. This is where we are right now, going back to 1990. So I'm just going to draw a line where we are here, and we can see, we're just going to say it's about 25 times. We can see there were a couple instances where the forward price earnings multiple got a little bit higher than we are right now. But one of those periods was the aforementioned tech wreck. The tech bubble, and then obviously once the wreck starts, then the multiple starts to come down. But it was in that time frame. And then, of course, more recently, and this was due primarily to a big drop off in corporate earnings. So the PE ratio can expand dramatically for two reasons. One is because stock prices rise without any kind of a setback, without earnings growing commensurate with that price appreciation. And the other is to have some independent event that comes along and hits the earnings of the index. A good example of that was the GFC. You can see over here, if you can see my cursor, that was a period when S&P earnings were dragged down primarily by financials. In the tech bubble, there were a lot of companies that weren't really making any money, sort of the pets.com era stocks. So their contribution to earnings was zero, or even potentially negative, because a lot of those were actually money-losing businesses. And so that would expand those multiples, even though some more conventional and mature companies might not have been trading at exceptionally high multiples. And then, of course, the pandemic, which we had here in 2020, that caused the PE ratio to expand again, because you had this idiosyncratic event in the form of a pandemic shutting down the economy, and suddenly there were companies that were experiencing massive losses. Some companies that, in particular, like the cruise lines, for example, were shut down completely, and yet they still had meaningful expenses, so they were taking on big losses, and that would cause that to expand. We don't really have that same situation going on right now. That is to say that we don't have that idiosyncratic event like the GFC or like the pandemic plunge where there was a shutdown of economic activity. So this multiple that we see right now is probably more commensurate than with that 98, 99, 2000 period, just to say that stock prices appreciation is outpacing that of the pace of earnings growth. Okay, so I bring this up because we did get a question right off the bat. Let me see if I can pull this up here. I think the first question we got was from Alex V. And Alex says, if you were to start a brand new portfolio today, what would be your strategy? BAATMAAN, any vol play? So first of all, let's just talk about what he's referring to when he says BAATMAAN. We talk about the Mag 7 or 8. I'm assuming when he says BAATMAAN, that's the acronym that would stand for Broadcom, Apple, Amazon, Tesla, Microsoft, NVIDIA. What am I not thinking of? Alphabet, I assume, in there. Maybe Meta. So I see one M. I would assume Meta and Microsoft would both play into that. So Alex V, if you're watching this right now, why don't you just clarify? I'm assuming that's what you're referring to. So let's just talk about some of those things first. I'm not a huge fan of Tesla here, just strictly on valuation. I think there's a lot of optimism that's been built into that stock. Look, I'm a big fan of Tesla, the company. I'm a big fan of Elon Musk. I'm a big fan of the products that they produce, but just not at these levels. Now, I could have said that, 100 points ago easily. Probably did say it 100 points ago, but still, it's hard for me to encourage people to chase Tesla on the basis of what might be, because I think there's a lot of good news that's been baked into that cake. Now, in fairness, this is a company that is able to produce EVs profitably. This is a company that is at the forefront of autonomous vehicles, and in a very cost-effective way. So depending on how this, what the regulatory fallout is going to be, my thinking on this had always been that when we think about wholly autonomous vehicles, like robotaxis, for example, that companies that had more than one sort of sensor type, more than one arrow in the quiver on that score, we're going to have a benefit. So that would include Waymo, which in addition to using CMOS sensors, we can think of that as sort of the eyes of the car. That's a visual camera. Radar and LiDAR, I thought would very likely be, part of the AV framework when these things went into production and were wholly autonomous. And my assumption there was that in part this was going to be because that would be touted as a potential safety benefit, because of course, an autonomous vehicle can process a lot of information concurrently, And using radar and LiDAR, it would be able to do things that human beings cannot. So presumably that combined with statistics that showed far better safety rates would be an advantage. Of course, it's a more expensive technology, but Waymo is, sort of leading the charge in that. Cruise now sort of in this retrenching period and getting absorbed back into GM and abandoning robotaxis, and also the fact that Elon has, I think their idea is that if human drivers can drive just by sight, then why can't cars as well? Especially if you have more eyes and more processing power. So in theory, it could be as safe or safer than a human driver on just CMOS sensors alone. Okay, maybe. But it had always been my thesis that at the earliest stages of releasing autonomous vehicles on the street en masse, that it was likely going to have some form of multi-sensor technology like Waymo or Cruise possess. So bringing that into the calculation, even if you do, okay, let's just give Tesla the benefit of the doubt. The issue I have is that if you take General Motors and Ford and Toyota and you add them together, and Volkswagen, you still don't get to the valuation of Tesla. That's not to say Tesla doesn't have other technologies that are important, that are relevant. But maybe I wouldn't be inclined to chase it here. So what about some of these other companies? Meta, I think, is, they're generating massive amounts of free cash flow, good growth on the top line, good growth on the bottom line. I think I have previously said on more than one occasion that the companies that I generally like most of all are going to be those that are growing the top line faster than the economy and the bottom line faster than S&P earnings growth. That is true for Meta. That is true for Microsoft. That is true for Alphabet. That is true for Amazon. That is true for Netflix. That is also true for NVIDIA, with the following caveat I would like to add in, which is that 74 to 75% gross margins, 55% net income margins is extraordinary. And is it sustainable? So it is for as long as they don't have any meaningful competition, which they don't at the moment. But there must be almost no challenge greater for those in Silicon Valley and beyond that to essentially tackle than NVIDIA's business. And of course, people are going to start discounting in potential quantum computing. We're starting, that's more into the conversation now. It's not commercially viable as it stands right now. The ones that IBM has built, they've spent massive amounts of money building these machines that have a relatively small amount of qubits, and also Alphabet. But their time will come, and we should anticipate that the companies that are poised to benefit from that are going to see benefits to their share price even before they fully commercialize it, right? And in the same way, we might begin to see that there's some multiple compression in companies like NVIDIA, even as they continue to grow. So we're looking at anticipated year-on-year revenue growth of something like 50%, which is obviously exceptional and makes the company very reasonably priced at whatever, 35 times forward. I'm going by memory, we can look it up. But those margins are going to be difficult to sustain in the very long term. And at some point, the company is going to continue to operate well, but the share price appreciation is likely to slow. And I think we're getting closer to that level. And now that we're into the new year, for anybody who was maybe deferring their sales for tax purposes, they have an ability to do that. I will also add, though, and I've said this before, that because of the increase in interest rates, it is now possible to put on long-term collars in a name like NVIDIA with very favorable risk-reward relationship. We're talking about 50% upside, 10% downside going out to 2027. So some people may not have to sell their stock. The other thing I would also say is that passive investing, it creates a natural tailwind for the largest companies in the S&P, because every single time people get a paycheck, some portion of that goes in, and the largest portion of that is going into the largest companies, just because those are the, it's a cap weighted money flow. So all things to think about there. And if you were talking about NVIDIA with the N, by the way, Alex, I like Netflix. So Netflix, I've referred to it before as an unregulated utility. I think it's one of the last things that people would give up in their household. It's not massively expensive. It's great entertainment value per dollar. They probably, although some surveys have shown that people say, oh, well, if they raise the price by some nominal amount, many people would cancel. And I would say cancel and do what? The other streaming providers don't really compete. And now that Netflix has managed to secure, I mean, obviously the Jake Paul Tyson fight was kind of a joke in that final fight sense. I would say that the undercard fights obviously were something else, but and there were some technical difficulties. But one of the things that also demonstrates is that once they build their network out so that it is capable of handling the kind of traffic that they had that day, that's a massive investment, and it creates a little bit of a moat. They have money to spend. They have a huge audience. Now they have a multimodal revenue model between advertising or subscriptions, and so I tend to like despite its increases, I still like Netflix. So there is that. There was another question that I got here, and I can't post it on the screen because it didn't come in that way. I think it was posted to the YouTube channel. Ranjana Gupta said, hi, Mike. For many fundamental metrics such as EPS, there are several versions. For example, EPS Basic, EPS Diluted, EPS Adjusted, EPS Normalized, EPS GAAP, EPS CAGR. Could you please explain the difference between these, and which should we use when analyzing a company, or do they all have their place? Okay, so I would absolutely say that they all have their place. CAGR, I don't think of CAGR. So that CAGR is an acronym, compound annual growth rate. So CAGR is just a rate of change, and you usually look at that over some period of time. So let's actually use an example. Let's use the S&P, so that we can sort of think about it that way. So I'll look first at basic earnings per share. So what is basic earnings per share versus adjusted, diluted, and so on? So that's basically, you take the business's net income and you divide it by the average weighted shares outstanding. So the difference between that and diluted is that when you look at diluted, so here we're looking at, this is just basic earnings per share, and this is going back for 3 years. Let's go back for 10. And this is monthly, but let me go to, I'm going to go quarterly for 10 years like this. Okay. So the diluted number is going to take into account convertible securities. For example, if you have convertible bonds, or if you have employee stock, unvested employee stock grants and options, things like this. So that will increase the share count typically when you account for those additional shares, and that will bring the EPS down, because since EPS is your net income divided by either your average weighted share count or your fully diluted share count, the fully diluted share count is going to be higher, so your EPS is going to be lower. Diluted EPS is typically going to be lower. You want to look at diluted EPS more in companies that have a lot of dilutive corporate actions. So if a big portion of the employee compensation comes in the form of employee stock grants and options, that dilutive effect can be quite profound. So you will want to pay attention to that. But that's when it's going to matter. There are other more mature businesses where they don't typically pay a whole lot. So that number is really going to be very close to identical. So what about adjusted and GAAP? So GAAP stands for the generally accepted accounting principles. So that's essentially when you report your earnings, what the way that they have to report it. Now, you would say, and then pro forma earnings are how management likes to think about it, right? So, and they might share that with the shareholders. So why would you ever want to sort of have that pro forma number rather than the GAAP number? So the reason for that would be that you might have a quarter or a year where a company is doing some form of restructuring, or you have any kind of unusual event that has an impact on earnings. And that could be negative or positive. You could have a positive impact as the result of some asset sales, and they recognize some things as income. And you also could have negative ones. So, for example, if two companies merge and their expenses associated with that merger that they decide to take could be, downsizing, and so they have accelerated retirement grants or all kinds of things like that. Those are going to be one-off events. And so if you're trying to get a sense for how earnings are going over the course of time, but you have this noise from these events that are one-offs, then you will want to adjust for that and say, okay, well, what would earnings have been if we weren't going to have these sort of one-off corporate events? So that's when you would look at perhaps some form of adjusted EPS or pro forma EPS as issued by the company management rather than the GAAP EPS, because generally accepted accounting principles don't allow you to say, oh, well, I'm not going to count that, so we're going to throw it out. That would sort of violate the whole idea of general accounting principles in the first place, right? So you care about both of these. I want to make one important point about this, though, which is that companies that issue pro forma earnings, if they just recurrently have, exceptional items, extraordinary items on their income statement that are negative, and they are always saying, okay, don't count that. They end up being a little bit like Judge Smails from Caddyshack, right? So you're going to have to, as an investor, make a judgment about whether or not what management is describing as a one-off and we should probably discount really should be or not. Because if they have a habit of always having these non-recurring items, then it doesn't really matter that one specific item is non-recurring. It's a pattern of behavior that is recurring. And so then I'd go back to the GAAP number. Okay. So the CAGR, the compound annual growth rate, that's what this is basically trying to get to. So if you can see, I don't know if we can blow this up, but you're going to see that the CAGR here over the last 10 years for the S&P is 7.69%. So the compound annual growth rate for S&P earnings growth is 7.7%. Now, of course, we had this big swoon in here, right? So when you start taking a look at these numbers, what you would actually end up with if you bought and held it and you sort of said, okay, well, what earnings did I actually get? Sometimes you have these swoons and you just take, okay, we have $60 in earnings here. We had 30 when we began, so earnings doubled. Yeah, but maybe a period when you were expecting to make 45 bucks a share for your S&P holdings actually turned out to be close to zero, or in this case, 28, 27 bucks, something like that, during the pandemic. But this just gives us a sense of the growth rate. So the compound annual growth rate is something that I also care about because I'm just trying to get a sense of a trend, and also whether those trends are decelerating. NVIDIA is an example where it's very likely going to decelerate simply because there's a law of large numbers impact that's going to kick in here at some point. So here we're looking at NVIDIA's earnings growth, right? And lately, it's straight to the moon, as we can see here. So, whether we think that pace of growth is going to slow eventually, we obviously have to think about that as well. Okay, so that is just on the topic of earnings per share. Salesforce, for example, was a company where I always used to take a look at the diluted EPS because they had, and then you have to go and figure that out, right? So you're going to have to say, okay, I'm going to include this in my fully diluted share count and so on. But, it might have knocked a couple cents in EPS off of several businesses if you didn't dilute it. But maybe that's not going to be that material, but it's certainly worth keeping an eye on. Okay, so let's see here. I think I had another question. Did I accidentally? No, here we are. Okay. Michael Anthony, I bought MFA, which said book value of 1842, which pays a 35-cent dividend each quarter, which looks cheap under 1050. Well, let's just take a look at the tangible book value. Per share. So for financials, by the way, generally we think of, buying them at a tangible book level of, call it 1 or less is generally pretty, that's usually a pretty good number. So in the case of MFA Financial, your tangible book value per share is 0.8. So that's a pretty good number. I'm going to throw another company in here for reference. Put in JP Morgan, which you can see is trading 2.5. Okay, so that's the good news. What's the bad news? So let's take a look here. Take a look at their balance sheet, first of all. Too bad. Looks pretty good, actually. So what is the problem? Why is this thing trading at a single-digit multiple? Other than the fact that, as I was saying before, it's going to be the mega cap companies that benefit from most passive inflows. MFA doesn't count. This is a small cap, almost micro cap. We're talking about a $1 billion market capitalization. So the other thing that I would like to typically look at, this one may just be off the radar here a little bit. This isn't a company, admittedly, that I have followed. So their dividends, so they're structured as a REIT, so a real estate investment trust. So the thing about REITs, this is kind of important to remember, is that REITs have to distribute 90%, I believe it's 90% of their taxable income to qualify in that structure. Now, the benefits of a REIT, of course, are that because they're essentially just distributing all of that income, they avoid some of the double taxation issues that would exist in a C Corp, for example. So that could be a benefit. I actually was just talking about another real estate. Actually, was I talking about? I may not have, actually, or maybe I intend to. So you guys are getting the first crack at this. This is one of the names I rather like, actually, another REIT for this year. It's been hard hit, but, I think, look, if you're in things like Bitcoin, really volatile assets, not a bad idea to have some other things in the portfolio that are very, very different. And so some of these REITs would certainly qualify. This one, which is one that I had been looking at, is also trading at a very low multiple. Not as low as MFA, it should be said, but it's a much bigger entity. So this is a $30 billion REIT. But yeah, it looks like I said, MFA. I wish I knew more about it. I'll endeavor to look into it a little bit more before next Monday's live stream. Try to find out a little bit more about that one for you. But it does look reasonable at first blush. Okay, so Michael Anthony also says, I think Powell put the USA markets into a bear market, or people saying Trump going to hurt companies' earnings. I don't think Trump is going to hurt corporate earnings. And as for Powell, I think it's a relatively measured approach that's being taken. The history has been the pattern of inflation is such that it tends to be there's a little bit of a wave that goes to it. It rises, some things come in that sort of slow down the pace of inflation, but then it has a tendency to reaccelerate. It's a little bit like when traffic builds up and a traffic jam and comes to a halt, of course in the opposite sense, then it accelerates and it seems like things are going to be okay, and then all of a sudden it sort of gets constrained again. And that's because you have these lagging effects. So you can have commodity price appreciation, and then that can level off and even dip, but then you can have a demand on the labor side for higher wages, and that creates the next wave, and so on. So because there are these delays that can flow through the economy in fits and spurts, then so too is that going to be true for inflation. So I think that the approach that the Fed is taking is probably the right one. Okay, so and again, I don't think the incoming Trump administration is unfriendly to business. Quite the contrary. I think it's friendly to business, and anecdotally, it seems like management is pretty happy about it. I mean, it is very clear on the immigration debate, for example, that there was a coalition of people that supported Trump that have very different views about immigration. I, for example, am a firm believer that we need to expand and simplify the H-1B visa program for skilled workers. And the amazing thing to me is that this has created a huge hubbub. There's only 65,000 of those issued each year. There's another 20,000 that can sort of get lumped into that. And then you have some that are renewed. I think the number in 2023 was something on the renewal side, something like 309,000. We've had 10 million undocumented workers cross into the country since Biden became president. People worrying about H-1B, they're really not focusing on the right issue. Those are people who are coming into the country legally, and their services are needed. And I would actually add one other thing here, which is that I saw somebody send a message to me because I had sent out an article about it and say, this is just a way to, lower wages. Well, no, this is not the case. So first of all, I hired H-1B employees when I was at Cantor. And the people that we hired under H-1Bs, we hired them because they had skills we did not possess. So when I see someone say something like, "Oh, we'll train up American workers," who's supposed to train them? Like, we were hiring people that had skills that I don't have, and that the other people inside the organization, we had 6,000 employees, we didn't have those people. We needed them. There was nobody in the organization that could train up domestic employees to do these jobs. We needed people who knew how to do these jobs. And it's not like we were, trying to find cheap labor. Most of those people had higher base salaries than frontline salesmen and traders would have because their skills were so specialized. Now, is that happening? Is that true in every business? I don't know. But this was a lot of hoops to jump through. It was not something that we relished. We really cherished those employees, though. I'm not going to embarrass any of them, mention them by name, but I can tell you that some of these were some of the best people I've ever worked with, so skilled. And we were very lucky to have them. And we weren't actually able to keep them for that long because their services were that much in demand. But there is a misunderstanding, I think, about this issue. And I think that in the incoming Trump administration, they are leaning more in the direction of being favorable to business because American businesses need these things. So anyway, let's see here. Which question did I put in here? Oh, yeah, let me put this in here. Okay, so my portfolio increased and beat the S&P, but has actually realized some loss because of hedging it with a SPY put spreads. What do you think? Am I doing right? My portfolio increased in value and beat the S&P 500. Good. but has actually realized some loss because of hedging it with SPY put spreads. Am I doing this right? So so Anil, just to be clear, when you say has realized some loss because of hedging, are you talking about the losses from the hedging? Or are you saying that in the aggregate, the portfolio plus the hedges lost money? Because that should not have been the case. The reason I say that is because volatility was relatively low at the beginning of the year. Another way to think about a hedged way to have exposure to the S&P would have just to go out and buy SPY calls, right? So at the beginning of the year, you had bought SPY calls. You would have made money holding that position through the end of the year. So it makes me wonder, and put spreads don't lose as much as outright puts. So I'm just wondering whether there might have been a sizing issue that may have impacted you there. Remember that the exposure you're going to want if and when you hedge, which is something you try to do tactically, that you're doing your notional calculations correctly. So for example, if you're using SPX, I'm going to just, let's assume the S&P is at 6,000, SPX has a 100 multiplier, one SPX put is a $600,000 notional, therefore, right? So you buy a 5% out of the money put on SPX, essentially you bought protection on 600,000 notionally. So if you have, you know, a $3 million portfolio, then you need 5 of those to put that on. So I'm a little bit losses just from the hedging side. Yeah, okay, so that's a normal. You're going to expect that, and I don't think that's a. I'm just going to put that up on the lower third. I don't think that's a bad thing, because what you're achieving is presumably lower volatility. Now, one way to think about this is that if I'm able to compress the volatility of my portfolio and reduce the worst case loss, you know, you can introduce more leverage. So that's the way we kind of think about risk-adjusted rates of return. So if you can create essentially the same performance and comparable levels of risk, but deploy more capital, if you're doing it appropriately, your risk-adjusted rate of return should be as good or better. That's really what we're trying to accomplish. Then everybody's risk threshold, their tolerance, is going to be a little bit different. So some people might be willing to stomach a 10 or a 15 or a 20% drawdown in their portfolio over the course of 3 to 6 months, for example. Others may not. So you can essentially dial up the leverage, dial the leverage down, or you can adjust your worst case loss using puts or put spreads. And I generally favor that strategy. I particularly favor it in circumstances where you are, for example, you have a lot of buy rates. A lot of times people who do buy rates and covered call strategies, they're looking for income, they're looking for relatively steady state returns. Well, people who are doing that and withdrawing some of the premium that they collect from selling calls, you need to actually create some protection on the base capital, essentially, that you have, because if you had a meaningful drawdown, and you start selling calls against that drawdown, you know, you can't really recover. So you need to have something offset that. And so in cases like that, and you know, this last year, especially in the beginning of 2024, and you know, we'll see how 2025 stacks up, but this was a very favorable strategy to have because index protection was exceptionally cheap compared to single stock options premium. So you could be in buy rights and covered calls, and then buy some S&P protection, and you know, really smooth out the portfolio, and you know, still end up collecting more premium than you were spending out. So I think that's Tucker D Dog. H-1B doesn't lower wages. Employer has to pay prevailing or high wage. Yeah, I mean that was my experience, to be sure. Eileen says, "Hi Mike, I'm still new to option, but just wondering if anyone's ever studied this. Is there a certain number of days before earnings that is more profitable for selling options? Certain number of days before earnings that is more profitable for selling options." Well, oh yeah, I see there's a follow-up here. I know you don't like selling into earnings, but my husband and I currently have a lot of United Health because we recently bought some and we're also just assigned some. Their earnings are coming up on January 10th. Yeah, so United Health, first of all, I like United Health. I like Humana also, for what it's worth. Occupy the same managed care space. United Health is best of breed, but Humana is a pretty good business as well. These things are trading at very cheap multiples, have basically been dead sideways now for a couple of years. We'll pull up United Health's chart right now. Oops, did I? So here's the thing. So generalizing about the number of days prior to earnings is a little bit difficult because it's going to vary a bit by sector. Let me tell you what I mean. So you can have companies that are reporting within the same space, and investors will try to get some read through on what's going on for one business to other related businesses, right? So you might, for example, if you're looking at home builders and you're looking at a company like Lennar, you might also be interested in seeing what's going on with other home builders that operate in the same demographic. So Lennar is sort of right on the median household income, median home price in the United States. So again, I like to use round numbers, but about $400,000 median home price in the United States. So if you see other home builders that are reporting around the same time, you can, especially if they occupy similar geographic segments, then you'll get some read through. So when you're talking about how many days before earnings, bear in mind that the earnings of related businesses can also affect that volatility. So it is true, as you point out, that it is my preference generally not to sell options going into earnings. And the reason is because it has been my experience, and also because of some work that was done, and I don't mind citing who it was, Matt Anderson, ORATS, which is Options Research and Trading Services, and other folks that I know that are in the space, have found that very often single stock options premiums have been fairly priced going into earnings, which means that you don't have a whole lot of edge by selling a premium into them. Now, of course, you may have more insights into a business, or you may have certain feelings about the industry or the sector that make you more willing to sell off upside in certain circumstances. And that's totally fine, of course, because the options premiums will be higher than they are in other circumstances. But I don't know that we can standardize how many days prior to earnings. I will say this, though, that when I'm talking about not selling into earnings, I'm talking about day of for that company, right? So that's usually what I'm trying to avoid. But that's also because, from my perspective, you're selling premium, you're selling upside calls basically to just squeeze a little bit more out of an investment. But chances are you own the stock to benefit from appreciation in that stock. And most of those moves, I think one study I was looking at indicated that about 40% of all of the volatility that takes place in a single stock occurs around their quarterly earnings. So, you're only talking about a handful of days, of trading days, but way outsized impact on how a stock behaves. So that's my thinking, but All righty then. Hopefully, some of you are still with me. Are we back on live again? Hopefully. I do not know whether this is working, but I will keep talking as if everybody can hear me and hope that you can. Okay, so the gist of it is this: when you're going into earnings, and there's some companies, and we're about to come back into the earnings season for a number of companies that generally don't move that much on earnings, very broadly held. The first large companies to report earnings in any given earnings season is usually the big banks, money center banks like JP Morgan, Bank of America, Wells Fargo, and so on. And we're going to have them all reporting around January 15th. So, these are companies that don't generally move that much on earnings. Now, of course, you could always have that event where it turns into something really wild and you do get one. Those are probably less of an issue, but there are certainly names where it's all about the their earnings when you're going to, NVIDIA would be a good example. Selling upside calls in NVIDIA, as tempting as that may be because the premiums look so juicy, I mean, take a look at how that stock has behaved in and around earnings. And you can realize that if you had sold off the upside before every earnings, that could have been extremely painful. Okay, so Patrick Hyland says, Mike, can you explain option skew and how that would affect the price of options? So option skew actually is the price of options. It is the relationship of options that are away from at the money to the at the money strike. So it's basically how we think about options premiums across strikes. Let me give you an example. And hopefully you guys can see my screen here. And we're going to do, okay, so we're just going to take a look at skew. So, and I'm going to look at this by strikes because this might be a little bit more intuitive. So let me get rid of this. Oh, my desk share is not on. Okay, hang on. Bear with me 1 second while I bring this up. While I'm bringing this up, I just wanted to make the following point, which is that you've probably observed this. So when options traders think about the price of an option, we think about it in terms of implied volatility. Implied volatility is the variable that we can put into an options model that describes that options price. So we have all of what are the inputs that we can put in? Most of these are known and are not a matter of an opinion. So examples of things that are known that are not a matter of opinion. The current price of the stock. I don't make that determination. It is what it is. How much time there is until a given option expires. Again, that is not within the control of the options trader who's trying to value the option. The risk-free interest rate. Risk-free interest rates are what they are. Whether you use euro dollar, or if you used to use LIBOR, or you now use SOFR, or you are looking at 1 month treasuries, T-bills, whatever it is. The important point is that the way that an options trader thinks about price is the one variable that you actually can extract to establish what the current price of the option is, and that's implied volatility. So if I didn't know what a price of an option should be, it's the assumption I put into the model, and if I know what the price is, it's what I can pull out. Okay, so I understand that the team can now see my screen. So a condo in Bend, Oregon, apparently not the world's best in terms of connectivity, but we're doing the best we can. But this I thought was a worthwhile exercise because we're trying to do it on sort of a technological shoestring here. Okay, so what we're looking at here are the implied volatilities for options that expire in 3 months on the S&P 500, SPX index. And what you will observe is that the upside calls have implied volatilities that are lower, and the downside puts have implied volatilities which are higher. And that relationship, how one is higher or lower than the other, is what we think of as skew. Not everything is skewed with we would call this negative skew or put skew when the puts trade with implied volatility that is higher than the calls. Not every instrument trades that way. There are, and really the reason that they exhibit this skewness is twofold. One is simply supply and demand, which is that there is generally in the S&P more demand to buy downside puts as a form of portfolio insurance than there is a demand to buy upside calls. So that creates that dynamic. But the other is also the reality of how stocks behave. So the distribution, you can imagine if you had a normal distribution, then the implied volatility would be the same for all of these options. But when a distribution is skewed in one way or another, so that it has a long tail to the right or a long tail to the left, and it's fat-tailed more on one side than the other, you'll see these dynamics. These are essentially techniques that people are using who price options to model the value of respective options to account for the fact that securities prices are in fact not normally distributed, which is the reason why if we looked at something like, let's take a look at something like, see if I can pull this up for a commodity like oil that might not necessarily have a similar, the skew in oil is probably not going to be the same. So here we are. So here we can see that it is more like a smile, right? So the price of upside calls and the price of downside puts, implied volatility is higher than the at the money. So this kind of a shape, when we see this in implied volatility, is more symmetrical. And the fact that those wings are bid up more than the at the money means that the options market is anticipating that the price is generally going to be around the mean, but that when it does move, you get these sort of fat-tailed events. So a non-normally distributed price behavior in this particular underlying asset is fat-tailed, narrow around the mean. Not that it matters, but a distribution of that shape is leptokurtic. That's what they refer to those. So that's going to be narrow in the middle, tall, and then fat-tailed. You'll get a distribution like this. And you will find that there are instruments that might be skewed to the upside. I don't know whether, so here, this is an interesting one right here. Now we're looking at MicroStrategy. So you get some of that upside and some of that downside. And let's throw in the Bitcoin ETF for comparison to see how much of, so obviously the MicroStrategy is levered, so it has a much higher volatility. And actually I should be doing this on moneyness so we can sort of look at it like for like. So now we're looking at, and I'm going to put them on the same day. So we would expect this to have a little bit more to the upside than the S&P did, and it does. And we would expect MicroStrategy's implied volatilities to be higher than Bitcoin's, which they are because it is a levered play. They borrow money to buy Bitcoin rather than it just being the Bitcoin. And so this is what you're looking at when you're thinking about skewness. Michael Anthony, what were you saying on MP on fast money on Tuesday? What was I saying? About MicroStrategy? So there was a little bit of a conversation that was going on about on Monday. Julie Beal was on, I was on, Steve Grosso was on, I think Carter Worth. So one of the things that Julie said was that all of this issuance, so selling converts, for example, is dilutive. And I don't know if that's what you're referring to, but yeah, let's just talk about the dilutive elements first. It actually comes into this to Ranjana's question as well, right? So Ranjana was asking about diluted EPS. Now, if you can imagine this, if you imagine that there is a business and you have a plant and that plant builds 1 million widgets a year and that company needs to raise capital and they're going to replace some machines in the plant. And to raise capital, they do one of two dilutive actions. So one dilutive action is they could have a secondary, so sell more shares to the market. So now, if you own a share of stock, what happens is, okay, oh, this is maybe, oh, I thought that was maybe a typo when you were talking about MicroStrategy. I'll finish this thought and then move on to that. So just an important point here as we look at MicroStrategy, though, because there is a little bit of a misconception about the dilutive effects of issuing converts. So a convertible bond, a zero coupon convertible bond, is a bond where the company sells the bond. They don't pay any interest on the bond. The bond is convertible into the underlying shares at the conversion price. Now, in the case of MicroStrategy, MicroStrategy is a very volatile company. It's levered to Bitcoin, which is itself a volatile asset, because a convertible bond's value goes up as implied volatility goes up because it's an embedded option, right? So in the same way that high volatility stocks create high priced options, they create high conversion prices on zero coupon converts. So what ends up happening is if he sells $1 billion worth of converts, those converts are convertible at maybe 50% higher than the current stock price. So if he sells $1 billion worth of converts, he can buy the $1 billion worth of Bitcoin. And the first 50% of the appreciation of the Bitcoin that lands on the company's balance sheet is actually accretive for the existing shareholders because they get that benefit, right? So if it goes up 100%, the first 50% of the appreciation of Bitcoin is accretive to the existing shareholders. The next 50% on that 100 would actually be effectively going to the convertible shareholders because they have a call option. That's what the conversion feature of the bond is. So this was something that, and I apologize because I got confused by the question. I thought it was about this and not something else. But Julie Beal was talking about she didn't understand why you buy MicroStrategy because of all of this dilutive issuance. And my point is that it isn't necessarily dilutive, not in the sense that people typically think. In my widget example, you replace the machines in the plant, you're still making 1 million widgets with new machines, but you have more shareholders. That could arguably be thought of as dilutive, although you have better machines. But in the case of the Bitcoin example for MicroStrategy, that's not the case. So yeah, that's this kind of goes to that adjusted versus diluted question. So you were actually MP. So you were talking about MP materials. Don't think it was me. I was not talking about MP materials. I don't think. Steve was the one that was talking about it. Okay, that could be. Yeah, and if he did, and it was the same one that I was on, I apologize. I didn't quite capture that. But okay, so there's another one we can look at for Monday. So MP, so that gives us two names, and MFA Financial for next Monday. And by the way, if you guys have anything that you want to look at, we're going into the new year here. Something you want me to take a look at that I'm need to sort of brush up on, throw it in here, and it'll give us a good launching point for Monday. Okay, and by the way, I apologize for the technical difficulties that we experienced, and I'm really glad that you guys tuned in here on a New Year's Day because we just chewed up an hour of your New Year's holiday. I wish all of you a happy and healthy New Year to you and to your families. My condolences, obviously, to those who are close to the victims in New Orleans. That's obviously a really ugly situation. And by the way, just on Tesla, I'm sure some of you caught this news, but there was, outside of the Trump Hotel in Las Vegas, a Cybertruck exploded. And I'm seeing a report that somebody was killed. That strikes me as, I mean, a Cybertruck in front of Trump Hotel. I don't know whether that's just an accident or something else, but if it was an accident, then that obviously is that might weigh a little bit on Tesla when it reopens tomorrow, but it seems very fishy to me. Seems very fishy. Could lithium-ion batteries? I suppose it could have happened, but it has sounds nefarious. But for that, I guess you're going to have to tune into another news source, because that's what I'm going to be doing. And I would like to thank all of you guys, though, for tuning in and watching as I come to you from rural Bend, Oregon, where they've had 220 inches of snow, which my wife and kids are right now enjoying at Mount Bachelor. I hope you guys enjoy the rest of your New Year's Day, and I look forward to seeing you here next Monday. Thanks for watching.